Hey, welcome everyone back to Vested Interest. This is Shane. On this video, we're going to look at the three stocks I'm going to be focused on in the month of December. I know we're already in December. Where did the year go? We're going to take a look at Havertys Furniture, Kraft Heinz, and Nutrient. And if you'd like to do me a big favor, hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. If you're a dividend growth investor, hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever we put out any new content. I do a stock pick of the day series Monday through Thursday where we take a look at a company stock that's pulled back on the day to see if it's presenting any value. If you have any suggestions for companies to take a look at, go ahead and drop those down in the comment section down below. Drop a comment and let me know what you think of the overall video. And doing that really does help out the channel to grow. Special thank you to the subscribers out there. The channel does continue to grow because of people like you. And if you'd like to buy me a cup of coffee, hit that thanks button down below. You'll see several tiers in there where you can donate to the channel. Really appreciate everyone who does that. And understand those of you who cannot. I understand times are tough, money's tight, and that's just the life we live in. But if you could do the rest, that would be great. And let's jump into number one on our list, Kraft Heinz. Now, this is, I have kind of a love-hate relationship with this one. I love the company. I hate that they are not raising their dividend, but the valuation has got cheap enough, or has gotten cheap enough, and is below my cost basis enough where I am going to add to this one reluctantly and bring my cost basis down. I'm still hoping over the next year or two that Kraft Heinz goes back to raising the dividends. Even slow dividend growth on this one would be nice with such a high starting dividend yield. But let's take a look at here. You can see here the EPS, earnings per share, is $1.11 per share. PE ratio current is elevated at 28.68, but the forward PE is what I'm looking at here. Very low, 10.57 going forward, which makes it very attractive in my opinion for the type of company that it is, right? I have a lot of Kraft Heinz products in my cupboard that we consistently buy. You know, whenever mustard runs out, we buy more Kraft Heinz mustard. Other thing, A1, whenever A1 runs out, we go get another bottle. So it's stuff that we're consistently buying in our household, and I'm sure a lot of others out there as well. This is a consumer staple product here, or company here. Dividend is $1.60 paid out in the year. A very nice starting dividend yield. Again, with no dividend growth, though. I will say that again. I would love them to start growing that dividend. This is one way I can actually grow my dividend a little bit because it's below my cost basis. So at a 5.01% starting dividend yield, very high starting dividend yield on this one. Ex-dividend date, November 29th. We are past that. I believe they are paying out, does it say ex-dividend date? November 29th and 12/27. So end of December, they're going to pay out their dividend there. So if you were to buy them, or if you had bought them before the 29th, you will receive that dividend at the end of the year, right before the calendar turns over to 2025, actually. Now, 52-week range as low as $30.40, as high as $38.96. So they are pretty close to their 52-week high after a 1.4% increase there on Friday. Beta of 0.46, less volatile than the overall market. The analysts do call it a hold. Now, they're not telling you to buy it. They're basically telling you if you own it, just sit tight. But I'm going to be adding, like I said, it's below my cost basis enough. I'm going to be adding this position. Price target is $36.90, which represents a potential of 15.42% upside, at least according to stockanalysis.com, where I pulled a lot of this data from, and Yahoo Finance on some of the other data, like the dividend history here, dividend yield theory we're going to look at here in a second. That's from Yahoo Finance. So those are the two sources where I pulled this data from. Same two sources that I use on my stock pick of the day analysis if you watch those videos. Okay, so ex-dividend date we went over. Let's take a look at dividend yield theory to see if this one is potentially presenting any undervaluation. To do that, we take a look at their 5-year dividend yield average of 4.55%. We compare it to their current 5.0%. They say 5.01 here. Yahoo Finance information, stockanalysis.com, just off a little bit. But either way, since it is higher and significantly higher than their 5-year average, that speaks to potential undervaluation, at least according to dividend yield theory. Now, payout ratio is elevated on this one, 144.14%. So that's something to keep an eye on. We don't like that to stay like that for very long. Return on invested capital, return on equity. I typically like 10% or better on both of these metrics, and it does not quite measure up for either one. Return on equity and return on invested capital is very low. Return on equity at 2.8%, return on invested capital at 4.97%. EPS growth, I like 5% or better projected over the next 5 years. Now they're sitting at 11.14%, so very fast EPS growth projection here. Revenue is projected to grow at 2.35% as well. Now we're going to jump down and look at free cash flow. I want growing free cash flow over time because typically if a company has growing free cash flow, they will raise the dividend, even though this one has not been. We're going to go back to 2021 here. You can see $4.4 billion in free cash flow. That did drop in 2022 down to 1.5 billion, but then back up in 2023 to 2.96 billion. In the trailing 12 months, looks like it's going to be another increase, though we don't have December's numbers quite yet, at 3 billion. So at least since 2022, there's been steady growth here. Repurchase of capital shares, they're also repurchasing their own shares. You can see back in 2021, 271 million, 2022 up to 280 million. And even though there was a drop there, that increase in repurchase of shares does not, represent even close to the difference there between 4.4 million to 1.5. So even though they increased the repurchase in capital shares, they still did have a decrease in free cash flow overall. Increased slightly again in 2023 up to 455 million repurchase shares, and it looks like the trailing 12 months actually will be its best year in the last 4 or 5 here at 843 million. Though we'll have to wait to see how December's numbers shake out. And part of this trailing 12 months also includes December of 2023. So that'll flip around to December of 2024, and then we'll know exactly what we're sitting with here. As you can see, I am long Kraft Heinz. I do have a position in this company, 215.39262 shares. I am down 9.65% or down $734.53. So again, it's below my cost basis, almost around 10%. So I'm willing to decrease my cost basis a little bit to add to this one over the next at least month here. So that's number one. Number two is Haverty Furniture Company, ticker HVT, out of the consumer discretionary sector here. And as you can see, EPS, earnings per share, at $1.60 per share. Price to earnings is 14.75 with a lower forward P at 14, still under the 15 I typically like for companies like this. Dividend is $1.26. That's on the year, so divide by 4 with a very nice starting dividend yield of 5.34. You're going to notice a common theme here, right? We're looking at high yields on these three that we're looking at for December. Ex-dividend date, November 26th, so we're also past that. Looks like they'll pay out on December 12th there. So if you bought them before that 26th or held shares before that 26th date on the 25th or before, you will get paid the dividend on 12/12 for those shares. 52-week range as low as $21.61, as high as $37.05. So you can see they're pretty close to their 52-week low again. Also, that's another theme you'll notice. A beta of 1.39. So this one actually is more volatile than the overall market. Analysts call this one a strong buy. Price target of $45, which represents a potential of 90.6% upside. Now, looking at dividend yield theory again, we take a look at their 5-year dividend yield average of 3.69%. We compare it to the current 5.42. They say 5.34, so a little off on the numbers here from Yahoo Finance to what Stock Analysis gave us. But either way, both are well above their 5-year average. So again, speaks to potential undervaluation, and not only undervaluation, but significant undervaluation. Now, this payout ratio is a little above the 75% that I typically like, but it's not near close to what we saw with Kraft Heinz, where they were well over 100%. They're at 77.5%, so still gives them some room to continue to raise that dividend without having to do things like issue more shares or anything along those lines. Return on equity and return on invested capital, again, pretty low, under the 10% I'm looking for. ROE at 8.57 is not terribly far off, but return on invested capital is at 3.31%. They did not list EPS growth or revenue growth, which leads me to believe they may be expecting some negative, or they just don't have updated numbers yet. Again, free cash flow is what we're going to look at down here. 2021, you can see 63 million in free cash flow, drop down in 2022 to 22 million, jump up in 2023 to 44 million, and it looks like the trailing 12 months is going to be similar to what we saw in 2022 at 28 million. But this is a cyclical company in nature, right? Furniture company. Not everyone needs furniture every year, but whenever you need furniture, typically you're going to go out and buy what you need. Maybe around a bonus or return on taxes or something like that, but you're not going to sit around for very long on a table or chairs that don't work or broken, or if you don't have any, eventually you'll buy them. That's just the way furniture works, or at least has been in my household. Now you can see they do repurchase their own shares as well. They're up and down with that as well. 2021, nice repurchase, 41 million here. 2022 is down to 29 million. Looks like they decreased that significantly again in 2023 to 6 million, and trailing 12 months even further to 3 million. So it looks like when they have significant free cash flow, they are repurchasing shares, but they do stop or decrease that as free cash flow decreases. So that's one way they can help continue to increase that dividend. They'll stop repurchasing their shares and pay that dividend out instead. Now, I do, again, long here, have shares of Haverty Furniture Company, so 199.85827 shares. Currently, I am down 12.95%. So again, over 10% or around 10% and over is where I look to add to positions that are down, sometimes even less than that. This is one I'm comfortable with, such a high dividend yield, and the numbers overall looking pretty good, that I want to add to this one, decrease my cost basis, increase my dividend yield, and increase my potential future return, right? If they hit that $45 mark and I can get my cost basis down, that would be a significant return. Not saying they will, but it could happen. And last but certainly not least, Nutrien. Now, I will say Nutrien, ticker NTR, this is out of the material sector. This is, in my opinion, the most, I wouldn't say worrisome stock, but the cyclical nature of this, again, they could go lower here and stay low for a while until they bounce back or have an upturn in what their products, as far as around farming, are producing. But right now, it's a cyclical company. They're in a cycle, it seems like, on the downside. In my opinion, that's the time to buy. But they could go lower. It just could happen. Now, EPS sitting at $1.48 per share. PE ratio at 31.45 currently. Forward PE much lower than that at 14.36. Dividend $2.16, again, divide by 4. Now, this is also a Canadian company, so there are some tax implications. You need to understand whether you are going to be responsible for paying those taxes or whether your brokerage takes it out whenever they pay the dividends. My brokerage takes it out whenever they pay the dividends. If yours doesn't, you will have to pay the taxes. Okay, you just need to understand that and talk to your tax advisor about those taxes if you hold any foreign companies like Nutrien. Again, this is a Canadian company here. Dividend is 4.63%. Again, the theme of the day, high dividend yield, maybe a little riskier on some of these, especially ones with over 100% payout ratio or something like that, like this one does, right? 145.27. Now, this company does issue shares from time to time to help with that. That's one of the things you'll have to understand about this company as well. But they may also, on the flip side, buy back a significant amount of shares whenever their free cash flow is up significantly. One of the things you want to look at for companies like this is whenever they are repurchasing shares, does it offset what they've issued into the market? And when they're paying down debt, does it offset if they've been issuing debt, right? Those are two metrics you want to look at together. But back to the company here. Ex-dividend date, September 27th. Looks like they're going to pay out. Actually, it looks like they have an ex-dividend date coming up on December 31st. So that would have been the one before this. So December 31st will be their ex-dividend date with a payout in January of 2025. 52-week range as low as $44.65, as high as $60.87. So another one that's pretty close to its 52-week low. A beta of 0.95, so they're just slightly less volatile than the overall market. Analysts call this one a buy as well. Price target of $59, which represent a potential of 26.45% upside. We're going to look at their dividend yield theory again to see if this one is potentially undervalued. 5-year dividend yield average of 3.46% compared to the current 4.63. Over here, these ones happen to match at 4.63. And since it is higher than their 5-year average and significantly higher, at least according to dividend yield theory, that speaks to potential undervaluation. Now, payout ratio is, again, elevated, 145.27%, something to keep an eye on there. We went over ex-dividend date and payout already. Return on equity and return on invested capital. Again, I like 10% or better for both these metrics. This is another one that sits a little below, well, significantly below what I'm looking for there. Return on equity at 3.02%, return on invested capital at 4.1%. Neither one hit the 10% I'm looking for there. I'd like to see them improve that on all of 3 of these companies, actually. Earnings per share growth, though, looks good again. EPS at 13.38% projected over the next 5 years. I like 5% or better. They did not list revenue growth. I anticipate it to be either flat or negative, actually. And again, cyclical company here. Now, going back to 2021 here in free cash flow, you could see $2 billion in free cash flow. 2022 jumped up to $5.6 billion. 2023 back down to that $2.3 billion, and the trailing 12 months pretty close to the same as 2023 numbers at $2.33 billion And that looks to be going back a few years around 2 billion, 2.1, 2.3, 1.9. That looks to be consistently what they're at, where they have some years where they jump up like they did in 2022. Repurchase of shares. Now, this is one, as you can see, they definitely fluctuate the repurchase of shares to coincide with their free cash flow growth. 2021 here at 1 billion in repurchase of shares, 2022 at 4.5 billion, 2023 back to that around 1 billion there, and the trailing 12 months so far only 50,000. So it looks like they may have decreased that significantly, which they should if their payout ratio is so high, but we still do have the month of December. Now again, you want to look at this because they do at times issue shares. Now, when I looked at that and compared the repurchase of shares to the issuance of shares, years like this, they are repurchasing a significant, extremely large amount more of the shares than they are issuing shares. So they are issuing shares at time to help with the payout ratio, but then whenever they buy back shares, it is typically way more than they have issued. Again, another one I'm long. I own all three of these companies here. Nutrien, 200 shares. My cost base is $46.70. I am down 11.7%. Again, around that 10, 11, 12% range there that I'm down. So this will significantly decrease my cost basis as I add here, as well as increase my future yield. And all of these have significantly a significant impact in yield on my portfolio, 4.6% and better on all three of these. The other two around 5%. So trying to juice up the yield a little bit, decrease my cost basis on these three companies. And I still think they're good companies. That's why I continue to hold them. Now, these are some other companies. Some of them are in my portfolio: Pfizer, Valet, Realty Income, Lam Research, Alphabet, and CVS. All companies I will probably nibble on at different times in the week, whichever one seems to be the most in the red. Pfizer is in the red in my portfolio. Valet is below my cost basis. CVS, same thing. Realty Income bounces in and out below my cost basis. Alphabet is actually above my cost basis currently, but I've been adding a little bit there, at least over the last month, several months actually, to Alphabet. And Lam, same thing, at least over the last couple months I've been adding there, and I may still add a couple of shares every week. Now, General Parts Company, General Mills, and Chevron, and several others out there are currently way down, that I think are good companies as well. You might want to look at if they are not in your portfolio, might be worth taking a gander. But these are all companies I think still are showing some good valuation and wouldn't be bad to add to if you own them or if you're sitting on the sidelines thinking about jumping in on them. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think of the video. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So again, if you have any questions about the stocks that I chose or comments, go ahead and drop them in the comment section. And also, if you have any suggestions for the Stock Pick of the Day video series, go ahead and drop them in the suggestion box as well down below in the comment section. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and selective criteria, or seek the advice and counsel of a certified financial advisor.